And good afternoon, everyone. For those of you just joining us, we do have about 5 minutes before the presentation begins. So sit back and we will be right back with you with Kristina Hooper. And thanks for joining us, everyone. We do have about 2.5 minutes before the presentation begins. One thing to note, that you do have a chat and ask a question feature just to the right of your player on your screen. So feel free to type in any questions as we go. Time permitting, we may have time to get those answered for you. So keep those coming in, and we'll be right back here with you in about 2 minutes. Thanks for joining us. All right, Kristina, we are about 1 minute and 15 seconds before the presentation. If you want to go ahead and take control of the screen share, we'll make sure it looks good.
How's that?
All right, looks great. I do see it full screen, so you're all set. And I'll just lead with a quick intro, and then we'll be ready to go.
Fantastic. Thank you.
Thank you. All right, everyone, welcome back. MoneyShow is pleased to welcome Kristina Hooper. She is the Chief Global Market Strategist at Invesco. She entered the financial industry in 1995, and prior to joining Invesco, Kristina was the U.S. investment strategist at Alliance Global Investors. She has regularly been quoted in the Wall Street Journal, the Financial Times, the New York Times, Reuters, and other financial news publications. She was also featured on the cover of the January 2015 issue of Kiplinger's magazine and has appeared regularly on CNBC, Bloomberg TV, Yahoo Finance, and Reuters TV. Kristina, thank you so much for being here. It's a pleasure. It's all yours.
Thank you so much. It is absolutely a pleasure to be with you all today. I'm going to move through these slides pretty quickly and try to skip over a few just so we can leave a few minutes at the end for questions. Let's start with this slide, which I think helps put the current crisis in perspective. Of course, the worst crisis that we've experienced in the last 150 plus years is the Great Depression, and that is represented in that dark pink line. While initially many, I think, compared what we're going through now to the Great Depression, it is not as significant. In fact, we've put together a number of possible scenarios represented in the gray shaded areas on this graph. And what you can see is that none actually fall to the level of the Great Depression. This is more akin to the global financial crisis. And in fact, our expectation is that a few years out, the outcome, even the worst outcome, will be actually better. We'll have a faster recovery than the global financial crisis. But I have to give the caveat that there are a variety of different possible scenarios. A lot of that has to do with the fact that there are so many factors at play. This is not a normal crisis. This is more complicated even than the global financial crisis because there is that additional dimension to it, that health dimension, which, by the way, is out of a lot of market participants' areas of expertise. And it adds a lot more complexity, as I said, to the situation. So, what I laid out here are some key factors that have, I think, a very significant amount to do with the kind of outcome we see, the shape of the recovery that we experience from here. Of course, infection rates are critical. A country, a region's ability to control the virus is essential to their economic outcome. But there are other health related issues, the development of therapies, and of course, ultimately a vaccine. Stringency measures. Early on, in particular, they were very predictive of economic activity, and I'll spend a minute on that. Mobility is now, I think, even more important in terms of understanding what we're going to see with regard to economic activity. Fiscal stimulus is also important, and that's certainly something that's being talked about a lot right now in the United States. Finally, monetary stimulus. I should give the caveat that monetary stimulus has a much greater impact on markets than it does on the economy, but it's certainly worth discussing as well. So, what I've laid out is 5 possible scenarios. Again, because there are so many variables at play. You can see the worst case scenario we've assigned a very low probability to, just about 5%. Now, that truly is a worst case scenario in that we don't just expect a very strong second wave, but waves that follow that second wave. This, of course, would assume that it would take a long time for us to get a vaccine. Essentially, as I said, a really the worst case scenario. The bad case scenario is assigned a much higher probability, about 25%. That would be a second very strong wave in 2020, so significant that it would require the reimposition of lockdowns. Certainly more likely than the worst case scenario, but it's less likely for sure than our base case scenario, which I've assigned a 40% probability to. That would be a continued gradual easing of lockdowns, no significant second wave, and any kind of increase in infections would be easier to control, to manage, lower mortality rates. And of course, after the initial slower pace of economic recovery, it would take off. It would be more significant, and that would be shaped like a Nike swoosh. So you can see the worst case scenario is a W-shaped recovery. Bad case scenario is more of an L-shaped recovery. The base case would be a Nike swoosh-shaped recovery, trademark included in that line. The good case scenario is about a 20% probability. That is an environment where we would see rapid easing of lockdowns, something of a delayed return to normal behavior, but no reimposition of lockdowns. And we get a vaccine, certainly therapies would be developed that are effective, and of course, an effective vaccine sooner rather than later. Finally, the best case scenario, that's when the stars are aligned. That is a situation where we would see a rapid easing of lockdowns, a speedy return to normal behavior. And that, of course, would likely go hand in hand with the introduction of an effective vaccine very quickly, like the back half of 2020 or by the end of 2020. So that kind of lays out the possibilities. But again, there are so many factors at play that I didn't think 3 scenarios did it justice. It really seemed like a situation that's so complex that there are really about 5 possible scenarios. We all know where COVID-19 has fallen in terms of mortality, but also its ability to spread quickly. I think this is still something of a moving target as we learn more and more. And in fact, this slide comes from February 29th. I think we've altered our views since then and may have come back somewhat to where we started from. But what we have to recognize is that different countries have had very, very different degrees of success in containing this virus. This chart here shows that essentially there has been difficulty in the United States, as we know, in controlling the virus. Other countries have been able to bend the curve sooner. And of course, there have been countries that have successfully bent the curve and are now experiencing a pretty significant surge, like the Eurozone. This perhaps illustrates this better, where you can see Asian countries like South Korea and China have been able to really manage this virus well after initial issues. A lot of that has to do with the fact that governments have had some experience with pandemics, with controlling infectious diseases in the recent past. And also there is a very, very strong contact tracing infrastructure in a number of Asian countries. And I think that has a lot to do with their success. Emerging markets are very much a mixed bag. Of course, we already talked about China, but you can see that Mexico has had some difficulty. Brazil, and of course, India is the area we're most concerned about now. Not only are infections on the rise, but they are already reducing stringency. They are rolling back lockdowns, even though the virus hasn't been managed. Perhaps it's easier to look at this in bar chart form. And so what you can see here, or mountain chart, excuse me, form, what you can see here is that key economies, again, have had varying degrees of success. Now, we've worried a lot about a second wave coming in the fall, that this could be something of a perfect storm, back to school season, followed quickly by flu season. But in fact, what we've actually seen is a second wave has already hit a number of countries. You can see Spain and France, you have levels of infection like you saw in the early days. Now, this isn't even the second wave because that's expected to come in the fall. I think of this as the 1.5 wave for a number of countries. And again, I should point out Japan, certainly a very low level of infections relative to the population, but this wave 1.5 is bigger than the first wave. France and Spain have been part of the big uptick in Europe, and I should say that has a lot to do with summer vacation and just relaxing of personal stringency. Now, in the United States, if we were to dive down, of course, we would see very significant differences by region. My key takeaway from this chart, and I think it's certainly something encouraging as we look ahead, is that there's been an incredible amount of learning that has taken place just from the experience of the Northeast. As you can see, the Northeast mortality is so much higher than other parts of the country. And a lot of that had to do with what doctors learned. Initially, when oxygen levels dropped to what were perceived to be dangerous levels for non-COVID patients, COVID patients were immediately put on ventilators. Doctors learned that actually COVID reduces oxygen levels by a lot, but it's actually better to try to forego putting them on ventilators. We also learned, the medical professionals also learned that steroids are an effective treatment. They can really lessen the impact of more severe cases of COVID-19. In fact, the World Health Organization just came out with guidance a few weeks ago that medical professionals should use steroids. And of course, they are cheap and abundant, so that is an effective treatment. All this is to say that while we may not have a vaccine, and I wouldn't expect a vaccine, our base case is next summer. I wouldn't expect a vaccine in the near term. That doesn't mean we aren't going to have effective therapies to mitigate the damage created by COVID-19. This gives a little of insight into what's going on in Asia. Again, the area of concern is India, not just in terms of infections, but in terms of deaths. In Europe, as we saw in regions other than the northeast of the United States, this wave 1.5 has not resulted in significant deaths. It certainly hasn't been like the mortalities experienced in the first wave. And again, I attribute that to what has been learned. In the Americas, of course, Canada is the bright spot, but the U.S. has been able to manage this. Mexico and even Brazil have been able to manage this after some significant difficulty. Of course, one of the other major factors contributing to what shape the recovery takes is the development of a vaccine. So this is just intended to be a helpful chart that shows the different phases that drugs go through before approval, and also gives you a sense of which companies are in phase 3 trials. You may have heard last week in the news that AstraZeneca was withdrawing from phase 3 trials, and then over the weekend it was announced that they were resuming them. That is very typical. We often see companies withdraw from trials when one patient or more has an adverse reaction, some kind of significant health consequence. But usually that doesn't mean any significant setback. It's essentially hitting a pause button to understand what happened. And then, as we saw with AstraZeneca, it was quickly resumed in terms of the phase 3 trials. Now, mobility, stringency, I had mentioned early on, was a great predictor of economic activity early on. And that was because government lockdowns were blunt instruments, and governments had to tamp down the virus. It was a necessity. There weren't enough hospital beds. And so we saw these sort of mass lockdowns. But we've seen a change of heart, change of views, and again, learning from past experience that that there are more surgical approaches to this. And so many governments have said they are not going to embark on widespread lockdowns again. And I think that's certainly what we're seeing now, and may very well be the case unless the situation gets extreme and there again is a situation where there are no hospital beds. The COVID-19 infection situation is very severe, and governments are forced to. But absent that kind of scenario, we have to, instead of paying attention to stringency, pay attention to mobility. And this chart gives a sense of mobility globally. And this actually comes from Google mobility data, although they provide it for most of the world, but not China. So this just gives a sense of what we saw over the last 6 months. I would focus in specifically on retail and recreation, and that encompasses shopping malls, retail in general, as well as restaurants. So that gives a sense of who's dining out, or at least going out to pick up items. And as you can see, there's been a nice improvement over time in retail and recreation, even more significant than transit stations. And I think that speaks to the pickup that we've seen, especially over the summer, in terms of economic activity. Interestingly, one could argue that there's some kind of correlation between that kind of improvement in mobility and the stock market. I also think there's that has a lot to do with monetary stimulus, but I'll get into that in a moment. But what this chart shows is mobility by region, and that dark line in particular represents 7-day average mobility. What concerns me is that we have seen a flatlining in the United States, whereas in the United Kingdom, we continue to see an uptick in mobility. That suggests that a lot of the gains we've seen in terms of economic growth may moderate this fall. So we want to follow mobility data closely. And in fact, we want to look at a lot of different data points to understand what is going to happen to the economy this fall. And so I'm sharing with you our dashboard that we like to follow. As you can see, gasoline looks quite similar to Google mobility. And I think, of course, there's a pretty strong connection between the two. You can see gasoline is down, gasoline usage is down well below where it was in 2019. Also tracking gasoline is open table dining, a little more volatile, but it's that same kind of trend. We've also seen an improvement in sentiment. So all good things. Although again, the mobility itself has flatlined a bit. And so I would expect it to moderate, certainly not deteriorate, but moderate. One bright area, just that I'd like to call out, is new business applications. You can see that it is much improved over 2019. Now, we saw something similar to this in the global financial crisis. Some of it is a function of necessity. When people lose corporate jobs, they're forced to become entrepreneurs. But that can often, especially in the right climate, one that's more supportive and stimulative, that can lead to a lot of innovation. So we'll want to watch that closely. We've seen a downtick recently, but still a very high level of applications relative to what we've seen in the last few years. And of course, the proof is in the green shoots that we've seen. And of course, that really nice acceleration in economic activity in the spring and early summer, but it has moderated somewhat later in the summer. We're, of course, want to pay attention to the employment situation. A lot of the gains, the easy gains, I believe, have already been made. We still have a high level of unemployment. So I do worry and expect that we're likely to see smaller job gains over the fall. And I worry about some jobs that are still at risk. In particular, you can see that other categories, a big category. In there is government jobs, state and local governments. Many of them have balanced budget requirements. Even those that don't are under significant pressure. So that is an area of vulnerability going forward. Now, fiscal stimulus is another factor that I mentioned that certainly has an impact on the kind of outcome, the kind of economic recovery we experience. And this chart gives a sense of, gives us some kind of sense of a country's ability to provide fiscal stimulus by looking at how balanced their budget is, but also their existing debt to GDP levels. And of course, the United States, we are not currently anywhere near a balanced budget, and we have rising government debt to GDP. Having said all that, though, we are in a unique position. We have that incredible ability to, because of our reserve currency status, to do more than other countries. But I often get the question, how do we stack up to other countries in terms of the kind of stimulus we provide? And so I share with you here an apples to apples comparison as a percentage of GDP. And you can see that the United States is well below other countries like Germany, France, and Italy in terms of total stimulus as a percentage of GDP, but is doing better than most in terms of direct stimulus, which typically has the most bang for its buck. And I've also included emerging markets in there. So what can we expect in terms of more fiscal stimulus? Well, this just gives a sense of what we've already gotten thus far, and in particular, what we got in phase 3. That's what's broken out in that bar chart. What was added to in phase 3.5. And then, of course, what is being debated today. Phase 4 could resemble something akin to the HEROES Act passed by the House in May. This is essentially the Democrats' proposal, and it is pretty big, $3.5 trillion or so, almost $1 trillion specifically allocated for state and local governments. And excuse me. Oh, I'm having trouble going back. And I should say that that this is very, very different from the Republican proposal. What we're seeing from the Senate, which is about $1 trillion and includes no state and local government funding. So that is the single biggest line item for the Dems, and it is not included in the Republican bill. The Republican bill, the biggest issue I would say is a liability protection for companies. So suffice it to say that there are a lot of differences between the two bills. It looks like it's going to be difficult for them to come to an agreement in the next few weeks. Hopefully they will. I'm always optimistic in an election year that politicians will come together because they'll want to be reelected. But I still think it remains to be seen whether or not we actually get that stimulus bill. And of course, we've also gotten a lot in the way of monetary policy stimulus. In fact, it's been quite extraordinary what we've gotten, much greater than anything we saw in the global financial crisis. Specific facilities for that have helped specific asset classes. But I think one area that has been overlooked, or one item that has been overlooked, is Jay Powell's speech at Jackson Hole a few weeks ago, where he altered, where the Fed is altering its inflation targeting policy, and is essentially going to be a lot more tolerant and allow inflation to run over the 2% target. Well, I don't think that's going to create a very inflationary environment. I think it's making the environment all the more accommodative, and that will have a significant impact on markets. We've actually already seen the kind of impact that monetary stimulus has had on markets, and it's not different from what we saw in the global financial crisis, in that risk and reward profiles were altered, investors were forced out on the risk spectrum, and equities moved up. Now, if you look at the emerging markets chart, I think that some of that performance was dictated, and in particular, Latin America's underperformance was in large part due to their inability to control the virus. But all kinds of asset classes were affected, not just by the crisis, but our response to the crisis, that monetary policy response. So we saw the 10-year yield come down significantly. We saw the dollar weaken, and of course, we saw gold rise, certainly in a response to those policies, but also, of course, geopolitical risk. The Eurozone has also reacted and certainly has seen concerns decrease since we saw the European Union come together for a historic fiscal stimulus. But certainly there was stress in the system for a while. In terms of high yield, we're seeing this. We saw the spread come down very significantly. Again, I attribute that to the Fed and what it's done, especially with specific facilities. What this has done in general is created an environment of more financial repression. This just shows where current yields are for a wide variety of asset classes relative to their historical range of yields, as well as the average. And of course, it shows that in some areas, some of the equity sub-asset classes, as well as real estate sub-asset classes, currently yields are not at the bottom, which they are pretty much for the other asset classes represented here. And that just tells us that we need to get more diversified in deriving income. So broad themes that I talked about: yield scarcity, growing debt, and of course, what I didn't touch on was deglobalization and that potential for it to occur. The U.S.-China trade wars really set this off. But since then, of course, the pandemic has increased or exacerbated the issue with supply chain disruption. There are some very significant industry themes that we've seen that I think have real legs. That be-at-home theme is not going to go away tomorrow. And in fact, I think we're going to see more flexible work arrangements once the pandemic is over. E-commerce, of course, there's been a much greater share of retail that has gone to e-commerce. I don't think that changes back entirely. I don't think the pendulum swings all the way back the other way. Drones, robots, automation, all have become more important in a pandemic, but I don't think that changes when the pandemic ends. Fintech as well. Two other themes: infrastructure. Both major candidates are talking about it. It's part of both their platforms. We're likely to see big spending on infrastructure, no matter who wins for president. And finally, real estate. There are clearly shifts going on, especially as people work from home. there's likely to be more need for commercial space, but different kinds of commercial space, like warehouses, as more e-commerce providers seek to have warehouses and facilities closer to where they are distributing the goods that are being ordered. So just a few other factors I'll touch on impacting the election. Specter of inflation. Certainly there's concern that monetary policy has become so accommodative that it's going to lead to more inflation. We heard that before in the global financial crisis. It didn't come to fruition. I suspect it won't come to fruition this time around either. That doesn't mean we don't want some kind of small long-term allocation in our portfolio that hedges inflation, but I think it is unlikely that we get that. US-China relations, I would expect them to get worse as we lead up to the election. Rhetoric already has been certainly getting more tense, more vitriolic. So I would expect that to continue and contribute to volatility, especially in the stock market. And finally, the US presidential election will certainly see volatility in specific sectors. Perhaps the greatest volatility will be in energy, because that is the one sector where we see such different platforms by candidate. But we're likely to see it in a wide variety of sectors. The important thing to keep in mind is that no matter who wins, it really doesn't matter over the long run if we were to look at returns over time. The market doesn't seem to favor much which party is in power. And so it really, if you are a long-term investor, I wouldn't sweat out the election, just expect volatility in the near term. So let me stop there and see if there are any questions.
All right, Kristina, thank you. Excellent presentation. We did have some questions come in from our viewers. One question, so they say, they believe it's kind of close to a guarantee that there might be one US company that will have a vaccine approved by the FDA before the election with dubious efficacy. What will happen to those companies' short-term share prices? We saw a decent spike when people were announcing their phase 1 trials. Do you foresee even bigger spikes, whoever that winner is?
That's a great question. I think there's certainly the potential for some significant spikes, but it's been interesting to see how quickly they evaporate. And so I would just say it's hard to guess at this point, but I wouldn't be surprised to see significant spikes. It just could turn on a dime, though.
All right, thank you. We had another viewer write in. They were wondering, are you aware of any studies that account for the impact on the economy of long-term serious COVID-related morbidities, such as heart-lung damage, strokes, seizures, Guillain-Barré, even some of these vaccines that we've seen, possible transverse myelitis. Are there any studies out there that you have seen what could happen to the economy long-term?
That's a great question. And I should say, when the virus began spreading in China in January, and my team and I would meet regularly to talk about what was going on, one of my colleagues based in Asia who had been there, who was born and raised there and had lived through SARS and a few other of the pandemics, had said, one of the things that many people don't realize is that there's some really very severe long-term effects coming from SARS as well. And he was the first person who clued me into paying attention to that. And yet I haven't seen any studies, although I wouldn't be surprised if there haven't been some studies on SARS, perhaps in with regard to something as specific as the Hong Kong economy, because I know it was hit hard by SARS. But I will definitely go back and look now, because I think that's a terrific question. We've always assumed that it would be a significant issue. There are already disability claims for COVID-19, and those are for the shorter term effects. So we have to recognize that it's going to have a long-term impact, probably similar to what SARS has had on some Asian economies. So that would be a helpful guide, but I haven't seen anything. But in truth, I haven't looked yet, but I will do that. So I appreciate that question a lot.
All right, no problem. Another one of our viewers, they're asking if you have any opinion on convertible bonds.
Well, I think that convertible bonds make sense as part of a well-diversified fixed income sleeve because we need to have an array of sources of income, including income sources that have that typically have higher yields. So I think it makes sense to have an allocation to convertible bonds for sure.
All right, and looks like we have one more question just came in to kind of wrap us up there. Wondering if you could share your view on the US dollar from, say, a year to 2 years out.
Uh, that's going to be a hard one. I think some of it is definitely dependent upon the election, and it's even more dependent upon how quickly there is a vaccine, how quickly there is a recovery. It's very, the Fed doesn't like forecasting, providing economic projections beyond about 18 months. And with good reason. I think it's very hard. It's perhaps even harder to divine what's going to happen to the dollar. Certainly in the near term, I think it will remain weak, perhaps get a little weaker. But it is, I apologize, but I just do not have visibility 1 to 2 years out.
Not a problem at all. That's a tough one for sure. All right, Kristina, thank you so much for being here today. It was a pleasure to be able to speak with you. We hope to speak with you again in the future.
Thank you. Take
All
care
right.
and have a great day.
You too. Have a great evening. All right, everyone. Another big thank you, Kristina Hooper, Chief Global Market Strategist with Invesco. It was a great presentation. To wrap up my sessions for the day, now we do have sessions tomorrow. We will be starting at 10 a.m. So make sure you join us back tomorrow for a full day, just like today. Also, if you are interested in on-demand videos, just visit virtualpass.moneyshow.com for more information. You can watch 40 plus high quality video and audio recordings, 20 plus hours of exclusive market insights and recommendations from world-renowned experts. And also you will notice there is a rate this presentation button above your chat. If you really enjoyed this presentation, go ahead and click those 5 stars. It was a fantastic presentation today. Again, join us back here tomorrow. We will kick things off at 10 a.m. and we really appreciate you joining us. So be sure tonight, if you have time, just reach out to a friend or family member. Let them know about these presentations. Really quick and easy to sign up for these free events to get all this great knowledge. And definitely we need to share this knowledge as much as possible. So reach out to anyone and have them sign up and let them know about us. So have a great evening, everyone. We will talk to you again tomorrow. Until then, thank you.